Imagine for a moment that you are the head of the world's greatest engineering company. For decades, your company has been synonymous with safety. Your company's slogan is, "If it's not Boeing, I'm not going." You built the plane that won World War II. You built the rocket that put a man on the moon. You are the epitome of American excellence. But then something changed. You stopped listening to the scientists who designed the wings and started listening to the executives who monitored the stock price. Suddenly you have a problem. Your competitor Airbus releases a new fuel-efficient plane. Your customers, the airlines, are threatening to leave you. You need a new product, and you need it quickly. So, you have a choice. Option A, spend 10 years and $20 billion designing a brand new, safe, state-of-the-art aeroplane. Option B, take a 50-year-old design, add some huge new engines, hide a software patch to ensure it flies straight, and sell it immediately to keep Wall Street happy. Boeing chose option B. They built the 737 MAX. It became the fastest-selling plane in history. The stock price hit an all-time high. Executives received millions in bonuses. It was a financial masterpiece. Then the planes started falling out of the sky. This is not just a story about a plane crash. It is the story of a corporate culture crash. It's about how the pursuit of short-term profit led to the deaths of 346 people and cost shareholders $20 billion. This is the story of how Boeing lost its soul. To understand how this disaster happened, we need to look not at the cockpit, but at the boardroom. For most of the 20th century, Boeing was an engineering firm. The engineers ran the show. However, in 1997, Boeing merged with McDonnell Douglas. It was a reverse takeover. The struggling McDonnell Douglas culture, which was obsessed with cutting costs, took over Boeing. The company's motto changed from "build great planes" to "increase shareholder value." Fast forward to 2011, American Airlines, a long-standing customer of Boeing, issued an ultimatum. "We are buying hundreds of new jets. If you don't have a more fuel-efficient plane ready now, we're going to Airbus." There was panic in the boardroom. If they lost that order, Boeing stock would crash. They couldn't wait 10 years to design a new plane. So they decided to update the 737, a plane originally designed in the 1960s. They wanted to install massive fuel-efficient engines. However, there was a physics problem. The 737 sits very low to the ground. The new engines were too big. To make them fit, they had to mount them higher up and further forward on the wing. This altered the aerodynamics. When the plane climbed, the weight of the engines naturally pushed the nose up. If the nose goes too high, the plane stalls and falls. This was a critical flaw. In the old Boeing, engineers would have said, "This design is unstable. We can't build it." However, the financial Boeing said, "Fix it with software." They created a secret system called MCAS, Maneuvering Characteristics Augmentation System. Its function was straightforward. If a sensor detected that the nose was positioned too high, the software would automatically force the nose down. This is where the greed comes in. This is the most shocking part of the financial story. Why didn't they inform the pilots about MCAS? Why wasn't it included in the manual? Because of money. Had Boeing admitted that the plane flew differently to the old 737, the FAA would have required pilots to undergo simulator training. Simulator training is expensive. It would cost airlines millions of dollars and take pilots off the schedule. Boeing had promised Southwest Airlines a $1 million rebate per plane if simulator training was required. That was the financial incentive. In order to save money, keep the airline happy, and maintain a high stock price, Boeing decided to hide the software. They convinced the FAA that the differences were so minor that pilots didn't need to know that MCAS existed. They even removed all references to it from the pilot manuals. They marketed the plane as the same 737 you know, just better. It was a lie. It was a completely different beast, controlled by a piece of code that relied on a single sensor. 29 October 2018. Lion Air Flight 610 took off from Jakarta. Minutes into the flight, a faulty sensor incorrectly informs the MCAS software that the nose is too high. It wasn't. However, the aggressive software obeyed its code. It slammed the nose of the plane down. The pilots fought back. They pulled up. The computer pushed down. They pulled up again. The computer pushed down again. This happened more than 20 times. The pilots had no idea what was happening. They were unaware of the existence of MCAS. They were wrestling with something they couldn't see. The plane dived into the Java Sea. 189 people died. How did Boeing react? Did they ground the fleet? Did they acknowledge the flaw? No. They blamed the foreign pilots. They protected the stock price. They issued a minor bulletin but kept the planes in service. They bet that it wouldn't happen again. They lost that bet. Less than 5 months later, Ethiopian Airlines Flight 302 crashed in exactly the same way. 157 people died. Only then did the world stop. The 737 MAX was grounded worldwide. The financial fallout was the opposite of what Boeing had hoped for. The stock price collapsed, resulting in the loss of billions of dollars in market capitalization. The cost of repairing the aircraft, compensating the airlines, and settling lawsuits exceeded $20 billion. They also paid a $2.5 billion fine to the Department of Justice to settle criminal fraud charges. Dennis Muhlenberg, the CEO who had presided over this culture of cost-cutting, was fired. But he walked away with a $62 million golden parachute. Consider the irony of that. They tried to save a few $1,000,000 on simulator training, and it cost them $20 billion and America's greatest manufacturing company's reputation. Do you know what Boeing spent its cash on during the years they were developing the flawed MAX? Stock buybacks. Instead of spending that money on R&D or safety engineering, they spent tens of billions of dollars buying their own stock to artificially inflate the price and trigger executive bonuses. The 737 MAX tragedy is the ultimate lesson in modern finance. It shows what happens when you treat an engineering company like a hedge fund. You can optimize a balance sheet, cut costs, and trick the regulators, but you cannot defy the laws of physics. Boeing traded its integrity for a higher stock price, and ultimately they lost both. The planes are flying again today. The software has been fixed, but the question remains. When you board a plane, who do you trust designed it? Do you trust the engineers who want to get you home safely, or the accountants who want to save $1 million?